Step 1. Identifying market structure multi-time frame analysis. The foundation of this strategy is a multi-time frame analysis before we even think about an entry. We must understand the direction of the market's higher high and higher low structure. Weekly, daily chart macro trend, we first identify the dominant long-term trend. As seen in our analysis of Bitcoin, the weekly chart shows a clear break of structure boss to the upside, indicating a strong bullish trend. This is our macro bias. This tells us that any bearish move is likely a temporary retracement, not a reversal of the entire trend. 4-hour, 1-hour chart micro trend. Next, we zoom in to see the short-term price action. On the 4-hour chart, we see a change of character chalk and a new boss to the downside. This confirms that a short-term bearish trend is in play. This short-term bearish move is our retracement and the part of the market we aim to trade. Conclusion: our analysis reveals a powerful dynamic, a bullish macro trend with a bearish short-term retracement. Our trading strategy will be to capitalize on this retracement. Step 2. Pinpointing the fair value gap FVG. The core of this strategy is the fair value gap FVG. An FVG is a key inefficiency in the market, an area where the price has moved too quickly, leaving a gap in the price action. From an SMC perspective, these gaps often act as magnets, with the market returning to fill them before continuing its journey. Identification: we identify the FVG on the higher time frames, particularly the daily and 4-hour charts. On our charts, we can see a significant FVG that the price is currently moving towards. This is our point of interest POI. This is the precise area where we expect smart money to enter the market, creating a strong reaction. Significance: the FVG provides us with a high probability entry zone. We don't just enter a random level. We wait for the price to return to this specific, predetermined area. Step 3. Execution and risk management. With the FVG identified as our point of interest, here is our step-by-step trading plan. Entry trigger: we wait for the price to enter the FVG on the lower time frames, for example, the 15-minute or 5-minute chart. We do not place a blind limit order. Instead, we look for a confirmation signal, a clear sign of rejection, or a structural break on the lower time frame, such as a smaller boss to the downside, indicating that the bearish move is starting. Stop loss placement: our stop loss is strategically placed just above the high of the FVG. This placement protects us if the market decides to continue higher, invalidating our short-term bearish thesis. Our stop loss is tight, but it is logical based on the market structure. Target and take profit: our primary target is the previous low created by the short-term bearish trend. This is a conservative and high probability target. We can also scale out of the position, taking partial profits at key levels before this target is reached. This is a crucial part of risk management, locking in gains as the trade progresses. Risk management rules: we adhere to a strict risk-to-reward ratio. For this strategy, a 1-to-2 or 1-to-3 ratio is ideal. For every $1 we risk, we aim to make at least $2 or $3. We also use a fixed percentage of our total capital per trade, typically 1% to 2%, to ensure no single trade can cause significant damage to our account. Conclusion: strategy summary. In summary, this strategy is a multi-time frame approach to trading retracements. We identify a macro trend, for example, bullish on the weekly chart. We find a short-term retracement against that trend, for example, bearish on the 4-hour chart. We locate a key fair value gap FVG as our high probability entry zone. We execute a precise trade with a clear stop loss and take profit based on market structure.